Data show consumer prices in the United States last month were up even more than expected, an increase of 7.5% compared to a year earlier. It's the highest inflation for the U.S. in 40 years. That'll make aggressive interest rate hikes by the Federal Reserve this year even more likely. Ji-yeon has this story.
Inflation in the U.S. climbed to its highest level in 40 years in January. The U.S. Bureau of Labor Statistics reported on Thursday that the country's consumer price index spiked 7.5% compared to the same period last year. Price rises for food, electricity, and shelter were the largest contributors to the increase. Inflation has been driven higher by soaring demand and lack of supply, mainly due to pandemic-led global supply chain crunch. And analysts say the rising inflation will speed up the U.S. Federal Reserve's key interest rate hikes this year. Rates are expected to rise at least half a percentage point by this March to dampen spending and thus bring down prices. This would usually mean that South Korea's central bank will also increase its key interest rate, but a local expert says it could be a different story this year.
A lot of analysts believe that U.S. will raise the rates too many times for Korea's comfort. So we may leave our interest rates level when U.S. raises its interest rates once or twice during the year. While that may be good for Korea's spending and macroeconomic growth, it may not be so good for Korea's capital flows because it will encourage foreign investors to leave Korea because of the lower interest.
The Bank of Korea raised its key interest rates 3 times during the past 4 months to 1.14% in January. It's one of the fastest paces among developed economies since other countries have kept their rates low to stimulate growth during the pandemic. The main reason for the fast rate hike by the BOK was to curb the country's staggering household debt, estimated at $134 billion. Kim Ji-yeon, Arirang News.